Hello, I'm Anastasia Meyer, an agricultural economist with Nebraska Extension in the Center for Ag Profitability at the University of Nebraska-Lincoln. Today is part of our weekly webinar series, typically live every Thursday at noon. Find the schedule of upcoming webinars as well as an archive of every recording on the center's website, cap.unl.edu. Today, many producers are looking at annual forages planted on cropland as a potential valuable feed resource for livestock. The Annual Forage Insurance Plan represents an opportunity for obtaining crop insurance to protect against the primary production risk of low precipitation. Several changes to the Annual Forage Plan of Insurance takes effects for the current sign-up period that ends July 15th. We will discuss these changes and tips on how to integrate annual forage insurance coverage into your operation. Presenting today is Dr. Jay Parsons, a professor and farm and ranch management specialist in Nebraska's Department of Agricultural Economics. He also serves as the director of the Center for Agricultural Profitability. Jay, thanks for being here to present.
Thank you, Anastasia, and thanks for the introduction. And also thanks for everybody for joining us today. Annual forages is a topic that we've been doing a lot of work on over the last couple of years, in particular with people planting what are technically called cover crops sometimes, but wanting to also use those as annual forages. And then RMA came out with this insurance for annual forages that, quite frankly, a lot of people don't know about. So it's an opportunity, as Anastasia said, to get some coverage protection on those annual forages. So let me start by just talking a little bit about, whether annual forages are right for you and where they might fit in your rotation and the purpose they might serve. So a lot of people, like I mentioned, they have an idea of planting cover crops, but then they're also looking at using it as a forage resource. And in some cases, a lot of cases, it's trying to replace hay in what would normally be a hay feeding period. A lot of cattle in Nebraska, of course, are on corn residue from the late fall into the on through the winter, and so maybe they're looking at replacing some hay feeding that would take place in the spring. So they're looking to perhaps in the eastern Nebraska in particular graze some cereal rye in that April-May period. Some people are also doing that in the planting in the summer and grazing in the fall. Some people are looking to perhaps be more integrative and actually including the annual forage as 1 year of the rotation on the cropland. So they may come off in May and replant and then graze in the latter part of the summer and on into the early fall with a warm season annual. So that's one thing to think about, is when you might be actually be using it, and in particular in terms of this insurance, how that influences when you might be planting it. So just a couple of quick examples. This would be like an eastern Nebraska example, again, where you're targeting in particular trying to bridge that gap in either the spring or the fall before you go to corn residue grazing or as you come off of residue grazing. And in this case, if you were going to actually graze on your pasture throughout the summer, so you're not needing it for the summer. Some people will come in after soybeans, plant those winter annuals in October, for example, early October, graze those in April, May. So they'd be looking at annual forage coverage on annuals planted in October, and so on. So this would be how it kind of meet eastern Nebraska needs to bridge the gap. Western Nebraska, where we're a little bit more challenged in terms of moisture, it still might meet a situation in there. A lot of winter wheat growing there. That comes off in July. So maybe they come in with an annual forage in the late summer, hoping for some rain and getting some fall grazing out of it. And then the next year, maybe they got some summer crops that are growing on there, maybe not. Maybe they come back with an annual forage in the spring and get some more grazing out of it during the summer. So lots of different ways to incorporate it into your actual cropping rotation. And in terms of the annual forage insurance, it's critically important because you need to know when you might be planting these annual forages, because that's when the insurance product actually attaches, and that determines the months that you're able to cover with it. If you're interested in some of those different forage systems and different actual plants that you might plant, whether it be warm season or cool season, There are some resources out there. This URL, go.unl.edu plant guide, has a whole bunch of information on there in terms of what you may want to plant, depending on the time of the year. This URL, go.unl.edu plan annual forage, is more along the lines of the graphs that I just showed you, how they might fit into your overall system, cropping and livestock. And then, of course, we got a lot of stuff up on our CAP website, which is cap.unl.edu, and it's /forage if you want to go directly there, but you can also find it up on the menu. And that includes several webinars that we did this last spring, along with animal science and crop science folks here at the university on some of these topics that you see here. We have some articles up there, some recorded podcasts, and then some various calculators, including a value of standing forage calculator. If you're a crop producer thinking of planting the annual forages and then actually selling it as a standing crop to a livestock producer. So all of those resources are available for you if you'd like to go take a look at them. A little bit more on the production side oriented than what we'll have here today, where we are going to focus on the insurance side. So insurance for annual forages is the title of our topic today. Let me start by just saying that this is officially called the Annual Forage Insurance Program. So if you're into government acronyms and you see AFIP anywhere, that's what they're talking about. It is a rainfall index insurance policy. So if you're familiar with the Pasture, Rangeland, and Forage Insurance, or PRF for short, it is using that same rainfall index, okay? So I'll start off by just giving a couple quick slides summarizing the Pasture, Rangeland, Forage Insurance and how Annual Forage Insurance is different from that, and then we'll work through some examples on it. So the rainfall index, of course, is a grid-based index, and these grids are technically 0.25 degrees longitude and 0.25 degrees latitude. So it's a square, but it's only at the equator. As we move north, it becomes more like a rectangle. And in Nebraska, it's pretty much about 16 miles north to south and about 12 miles east to west. But it is a grid, and it's not dependent upon county lines. It's not dependent upon your pasture fence line or anything like that. It's just a grid on the globe. So keep that in mind, that you may have a pasture that's in one or more grids to work with, and you may have one or more counties to work with on it. So it is based off of average rainfall. So it's an index base. So the index is 100%, and that's the average rainfall for that grid over a period of years. And it's a long period of years, at least 30. I'm not sure what they're using exactly right now. When this product first came out, they used all of the data going all the way back to 1948. They've since tightened that up, and my sense is that they're using about 30 years worth of data to get that average. But that's not really all that important. It's just important for you to know that it is a long-term average rainfall for that particular grid. You pick an insurance level, and you can go all the way down as low as 70% and as high as 90% in 5% increments. So for example, if I picked a coverage level of 75%, that would say that if the rainfall falls below 75% of normal, I would be entitled to an indemnity. So if the actual grid index ended up being 44% of normal, then I would get an indemnity worth about 31% of the dollar value I had insured. So it's very basic and straightforward, works exactly like PRF. There's not a lot of trickery to it, right? It's just NOAA data that goes back 30 years that they base it all on, and then as that data comes out in the year and in particular the interval that you have insured, they just take a look and see what your coverage level is and whether or not you're entitled to an indemnity. The idea behind it is low rainfall affects production, and that effect on production then is worth paying out an insurance indemnity to make you whole again, or at least partially whole. Okay, so I mentioned that it's a lot like PRF, and PRF is for perennial forage, so pasture, rangeland, forage. It's intended to use for livestock, okay? And annual forage works the same way in terms of it's intended to use for livestock, but we move from perennial forage into an annually planted forage. So PRF has a lot in common. As a matter of fact, everything in bold here works exactly the same in annual forage as it does in PRF. That is that you are utilizing these rainfall grid indexes to determine your precipitation coverage. And it's not a direct measure of your actual production loss. It's all based off of that rainfall index. The coverage is in 2-month intervals throughout a coverage period. In PRF, that coverage period is a calendar year. It's a lot more sophisticated in terms of the annual forages because it depends on when you plant it. And I'll show you that here in a moment. But just like with PRF, you can insure up to 90% of normal rainfall. So it's at 70 to 90% range at 5% increments. I already mentioned it's based off of this grid. Those are the same grids, same data. The subsidy levels are exactly the same, 51% to 59%, depending upon your coverage level. If you insure at the 90% coverage level, you get the lower subsidy of 51%, 80 or 85, this goes up to 55. And then at 70 or 75, the subsidy level goes up to 59%. All of that works exactly the same, no matter which you have, PRF or annual forage. So what's not highlighted in bold here is what changes for the annual forage insurance. Okay, and those changes are that it's an annual crop. Okay, it is intended for use as livestock feed, just like with the PRF. You don't have to graze it, though. It can be grazing, haying, chopping, lots of different things that you can intend to do with it, but it needs to be intended for livestock feed. The sign-up deadline for PRF was December 1 because it's based on a calendar year. For annual forage, it's July 15th, hence the timing of this webinar. Now is when people are signing up for it for the coming coverage year, which runs from July 16 all the way for, well, basically August 1, I guess, is when the rainfall or planting dates would kick in. But anyway, it's a full 12 months, but it's not a calendar year. So August 1 to July 31st on it. And you're covering, instead of a full calendar year, you're covering a 7-month growing season that depends upon when you plant it. So this is the sophistication of it. And that is that there's 12 growing season because there's 12 months from August 1 to July 31st in which you can plant it. And the month you plant it determines the months you can cover. So if you were intending to plant in August, you could cover rainfall from September through March in 2-month intervals. So you'll notice that all of these, we have 6 2-month intervals floating through here, 7 total months. You can't insure overlapping months. So if I was intending to plant an annual forage in August, I can insure September or October. Because I got October already insured, the next 2-month interval I can insure is November, December. And I'll show you some examples, specific examples for a grid here in Nebraska here in a moment. But the tricky part is you have to, by July 15th, contact your crop insurance agent, select what you would like to have coverage on, and get it in place. You don't have to report acres until after you have 5 days into the following month after the planting month to report the acres. So if I didn't know which month I was going to plant in, but I thought it might be somewhere over these August through October that I may be planting them, I would need to contact my insurance agent before July 15th, tell them what I want covered here, which months I want covered, what percentage I want in each 2-month interval, how the dollar value of coverage, and so on. Put all of those nuts and bolts in place so that then if and when I do plant acres, I report those acres to the insurance agent and then attach the actual coverage on those acres. So for the most part, people can at least, figure that out for the fall. But you also need to be preparing for next year. So if you're planning on doing annual forages anytime in March through July planting periods, same thing, you got to sign up by July 15th and tell them where you want the coverage. It's perfectly okay not to plant anything, report 0 acres, and not have any insurance premium due or any insurance coverage. That's not a problem. The main thing is you have to have the selections made now so that you can report acres if you have them. Okay, so just to summarize annual forage insurance July 16th through July 15th. Actually, I need to update that. The coverage actually isn't until planting in August 1st on through July 31st. There's 12 growing seasons based on planting month starting in August. The insurance coverage is available in 6 2-month intervals. Technically, you got 7 months to work there, but you can only get 6 months covered because you can only get 3 2-month intervals covered in that time span. You got to get all of the information to them by July 15th to get the coverage, and that is going to amount to selecting your coverage level, the amount of rainfall that you want to cover, the productivity factor, which will determine the dollar value per acre based off of your county-based value, and I'll show you an example of that here in a moment, but you can adjust that up or down. And then the intervals that you actually want covered, okay, and the percent of the value that you want to attach to those specific intervals. As I mentioned, the acreage reporting time frame is up to the 5th day of the month immediately following the planting month. So if I was to plant something in August and I had all this lined up, I would need to report those acres by September 5 to get the actual coverage in place. Okay, so let's look at some examples, and this is for a grid just south here of Lincoln. It's northwest of Beatrice. I like using Beatrice because it's right smack in the middle here, and depending on which direction you go, you're in one of 4 grids. But if you go north and a little bit west of Beatrice, you'd be in this grid right here, 24433. And I should mention, if you go into the RMA website and just I find it easiest just to go up in the search bar and type Annual Forage Insurance and click search. It will have a decision support tool there that you can click on and pull all this data up that I actually will be showing you. Of course, this is in Gage County, which is going to determine our dollar value of coverage per acre that we have available. So let's just say I'm looking at planting something right after fall silage harvest. So I have corn planted. I'm going to come in and harvest some silage on it, and then I want to follow in with some annual forage. And let's just say I'm not sure. I might get that in by in September. I might need early part of October to get that planted. So I'm looking at growing season 2 and 3 for coverage. Again, there's no penalty for going in and putting in the possibility of August or November coverage. That's not a problem. So if you want to do that, that's fine. But to limit it to a couple of different examples here, I'm just going to say I'm either going to plant in September or in October. If I plant in September, I can get coverage from October through April. If I plant in October, the months I'm looking at are November through May. So this is the way that would look in Gage County. The base value is $452.87 an acre. Okay. That's the 100% of the productivity factor. Now, again, I can adjust this up to 150%, so I can go 1.5 times that. I can adjust it down to 60% of it. I generally do not recommend people to adjust downward. It just attaches a lower dollar value, and you actually have to pay the same premium rates and so on. Some people that are looking to save money, the easiest thing to do that is to adjust your coverage rate. Now, it's not going to pay off as often, but keep in mind this is all actuarially sound. And I'll end with an example of different coverage rates, and you'll see how some of those have worked out. But if you adjust the coverage rate, it actually lowers your premium with it, okay? And so that's one way to save money on it. But in general, most people insure at the full 90% coverage rate. A lot of people do this 100% productivity factor. In Western Nebraska, where the base value is much lower, people will bump this up a little bit, get more dollar values per acre. But 90% of that $450 is about $407, $408 worth of protection. Because I insured at the 90% coverage level, I get a 51% subsidy. Now that works no matter what growing season I insure. So the example that I have working here, I said I could possibly plant in September or October. So that's growing season 2 and 3. So this is exactly the same for both of them. It's just a matter of where I want to put the coverage. So in September planting, I could start off with October, November, December, January, February, March. Now keep in mind, April's also a possibility, but I need to skip a month in here someplace in order to do that March-April period. So for this example, I just split the 100% out, 40, 30, 30. You determine this with your crop insurance agent when you between now and July 15th, when you at least put the possibility in place to have the coverage. So when you sign up, you determine those percentages. The policy protection is simply taking this 407.58 and splitting it out based off of these percentages I selected. And then the premium rate is basically based off of their calculations on their expectations for paying out. So they're going back historically for October, November, and saying, we need to charge about 20% of that protection, and because that's traditionally what we'd be paying out for that particular interval. Tendency is that winter months are more expensive to insure. Summer months where you have a higher, all of this is percentage based. So summer months where you have a higher amount of rainfall or precipitation in general, they tend to be a little bit less expensive to insure. But this is based off of their expectations for paying out. So you see the different premium rates that would attach to these three different intervals that I'm insuring here. The total premium would run anywhere from $22 an acre up to $33.57 an acre. So the total would be about $90.34. The government's going to pay 51% of that. So the producer portion of that would only be $44.26. That's if I ended up planting in September and I covered these months. Again, I would have to make these portions of the selection would all be in place by July 15th, and then I'd report acres against it, to attach to it that I actually planted in September. For October, we moved down one growing season. So I just did the first three intervals again here, but it's November, December, January, February, March, April. Again, none of these match up with these over here exactly, but we see a pattern emerging here in terms of the winter months being more costly to insure. That March, April, where we tend to get quite a bit of precip, is a little less expensive. So this one drops down a little bit in terms of the total cost, but very similar in terms of how that works out. So it's $43.59 an acre for the producer versus $44.26. Okay, so let's look at how some of these might have turned out. So that growing season 2, the first one on the left here, the September planting, we actually have all of the months in place. Keep in mind this production year starts in midsummer. So these would have been February, March of 2024 precipitation numbers here, and we actually have those in. So October, November of last fall, December, January of this last winter, February, March of 2024. These are how the index values actually turned out. December, January was above normal, so nothing gets paid out there. October, November, and February, March were below the 90% coverage level that I had. So I'm getting about 17.3% return here on this. And this in here, we're looking at about 21.4%. But that equates to about $30 an acre for each of those, or about $60 total. So my indemnity, if I had this coverage in place this last production year, would have covered the premium that I was charged. If we look at that over the last 20 years, from 2005 through 2004, this is the pattern that would have emerged. And this is just based off of actual rainfall data. That $44.26 premium would have returned $81.34 as an average indemnity. That loss ratio then for the producer would be 1.84. So that means this producer, for every dollar in premium the producer paid in, the return would have been $1.84 if I had this coverage in place consistently for 20 years. I like to look at things like, does it cover your premium over time? And in this case, 70% of the time it does. There's only 6 years in here where it doesn't. We see 3 of those are zeros, meaning I would have paid the $44.26 and gotten nothing back. 2019, 2012, 2010. Some other ones are pretty close. For example, 17 and 18, just slightly less indemnity than premium. So yeah, I would have owed a little bit of premium here, but not much. I'll give the same advice on this that I do with PRF. If this is a part of something you want to participate in, come up with a plan and stick with it. Because if I had this coverage in place and I hit this 2017, 18, and 19 period, and 19 was a zero, the temptation is to drop the coverage, right? You didn't pay for three consecutive years. I owed them money, and then I got topped off by the fact that they paid actually nothing indemnity to me. But look at that. If the next several years are quite lucrative. So come up with a plan and stick with it is the best advice I can give on any of these rainfall index insurances. So that's the September one. How would the October one have turned out? Well, October, we don't have the March, April data yet. It hasn't been published yet. So we're still waiting on that one. So I went back a year. This is 2023 results. And so this would have been November, December of 22, January, February 23, and March, April of 23. And we see, a similar pattern emerge here. That doesn't mean it's always going to be like this, but it did pay out an indemnity that covered my premium. This one, if we go back over 20 years, we see a little less lucrative payout over that time span, but keep in mind I'm 1 year back further on this. And if you look at 2004 and 5 in particular, there was no payout. So these things bounce around a little bit, but in general, your producer loss ratio is pretty comfortably above 1, just because of that subsidy paying half of your premium for you. But in this case, only 10 out of the 20 years did the indemnity cover the premium. And we see quite a few zeros floating around here. A lot of that is that last interval period that we have covered where it really doesn't pay out all that often on it unless it's really dry. But if that's when you need the moisture, that's a big deal for you as a producer. One last example here, and this would be if you're doing it in the fall type of thing. So, spring planting. So if you're coming in with the spring harvest of a crop, or you have some cropland available and you're looking at, say, a May, June planting period, and keep in mind, if you're thinking of this for 2025, again, you got to put the coverage in place now. If I plant in May, then I'd be covering from basically June through December are the months I can cover. If I plant in June, we're going from July through January as possible coverage period. And if you're thinking of July, of course, then you're into that last one, and you'd be covering all the way out into February of 2026. Okay, so let's just look at this May-June option. Okay, this would be growing season 10 and growing season 11. This information up here is exactly the same. We're still in the same county. We still have the same base value, et cetera. If I chose 90% and 100%, nothing changes up here. Okay, if I make that same selection on it. And keep in mind, when you put these in place, you can put, you're putting coverage in place for each growing season. So there's nothing that says I have to do 90% coverage here and I have to do 90% coverage here. I could actually change that up if I wanted, okay? But you're doing that up front between now and July 15th. So that splits it in this growing season 10, the May planting. I just, again, did the first 3 intervals. So going out to November. A little bit cheaper because we're in those months where we get more precipitation, less probability they're going to pay out. $67 total premium. Producer side, we're down to a $32.84 premium. If I'm looking at a June planting, those would come in a little bit more expensive because I capture that November, December period. A little bit more premium attached to that. A couple of months that are fairly, or a couple of intervals that are fairly inexpensive compared to that. But we're right at $76 total premium and $37.24 for the producer. Okay, so these obviously we don't have any results for this coming in 2024 yet, but 2023 results, that May planting would have paid out $36.69 with a couple of intervals slightly below average and definitely below our 90% coverage level. And then the June, July was above. But enough to cover our premium. Okay. And then again, looking at the 20-year span from 2004 through 2023 with that same coverage in place, that $32.84 would have returned $59.34 or about $1.81 for each dollar in premium. 75% of the time it covers, the indemnity covers your premium. And if we look over here, we see we got a couple of zeros floating around and a 14-cent floating around and a $12 floating around. Where's the other one? I think was pretty close if I remember right. Yeah, it's this one right here, $32.47. So just a few pennies under the premium. The June planting, similar types of results, although the dry one was just the middle September, October period, quite a bit below the 90% and enough to cover our premium. Okay, the other two intervals we insured were above. And again, if we look at that 20-year span, right, at 37.24, average indemnity of 65.57, producer loss ratio 1.76. So about 70% of the time, indemnity covers the premium. So if you do, I've done plenty of these in general because of that subsidy, because it's an index. You see a lot of the same numbers popping out in that 1.5, 1.6, 7, 8, somewhere in there, just depending on the timing of the droughts and so on and so forth. But definitely it's something that I would argue with our PRF coverage in the state. Last I checked, we're looking at about half of the pasture and range acres in the state are insured with PRF. It's really become a part of doing business. Annual forage insurance could reach that same level because it's working the same index. If it becomes a part of doing business with producers, again, it's something you got to plan a little bit further ahead. Not quite as simple as just remembering an annual December decision for calendar year coverage as we have with PRF, but still something that can be a part in your toolbox that can be just a part of your annual things to do. So just kind of cover a couple of little nuances on it to keep in mind. You can, if you're planting annual forages, if you have two crops in 1 year, you can cover both those crops, annual forages with this index insurance. You'll want to work with your insurance person very closely on this with your plans. Again, there's no cost to putting the coverage in place, but you want to make sure that you're, depending on when you plant, that it's actually eligible to attach. So this is an example, just one example. If you planted in August, you'd be in growing season 1. The last interval that you could cover would be February, March. So if that were the case, then you would not be eligible to plant again until February, and you could start to insure March through April would be the first index you could insure. So again, work with your insurance person with your actual coverage between now and July 15th. When it comes to planting, make sure that you're clear that what you are planting is eligible for coverage. If you're thinking of doing more than one crop in 1 year, but you can do that. You can also do a double crop situation. It's a similar deal. Again, you want to work very closely with your insurance agent on this and make sure that it's actually coverage. But if you had a spring or summer crop that you had going, in general, you can't get a full indemnity on both crops in the same crop year and the same acres. But if you wait until you get to the next crop year, that's a possibility. And out of convenience or chance, whatever it is, the crop year for our annual forage coverage starts in August 1. So let's just say you plant a crop in the spring, some reason it had a failure, you do some sort of crop insurance indemnity thing. When you look at that, oh, sorry, I should have updated that. I always have trouble with that. You look at something planted this year, say corn or soybeans, it would have a 2024 crop year. After August 1, or what we're actually signing up for right now with annual forage, it's actually the 2025 crop year for annual forage. So again, talk to your insurance person about that. Make sure that you get that outside of the current crop year that you're insured for the first crop, and you should be okay. But you'll want to talk to them about that. Okay, I'll wrap up here with some data, and then we have plenty of time for questions that people may have. So this is some data from Nebraska, Annual Forage Insurance Program. This has been around since 2014. So we're getting a decent track record here. We're now on year 11. You can see very little use of it in the early years. It's certainly picked up here lately. 2024, we have incomplete data, so that's not included in these averages that you see down here. But overall, we generally have seen about 58 policies sold on average. Of course, it's ticked up a lot as we've come through a drought and people are paying attention to this, and we're seeing more annual forages planted, et cetera. Policies earning premium are those that they actually attach acres to and pay a premium on. So we expect that not to be, not everyone is going to report acres once they have the insurance plan in place, as you can get from the way this is set up, you may, put the insurance in place for August planting and not get it planted until September, for example, and end up with a zero there for August, so it would not have a premium attached to it. But we kind of see how those numbers work out. Policies indemnified is what I pay a lot of attention to. Keep in mind the 2024 crop year still got several months left to determine indemnities on. But if you go back through time, you see almost all policies get some indemnity. Fairly high percentage here, roughly 90% of them are being indemnified. This is just in Nebraska. Average acres covered, we're up. Last year, we had about 50,000 acres covered. We still have some planting months yet to go. So this 38,000 may end up close to that 50,000 with some of these spring plantings that aren't showing up in the national data that I can pull from at the moment. So anyway, we've seen quite a bit of an uptick on that compared to where we have been historically. I won't bother too much with the premiums and the subsidy totals. You see those big numbers popping out there. And then the indemnities come out, and then the loss ratio is basically the indemnities divided by the total premium. So this is the product itself. It's at 1.1. Producer loss ratio takes into account these subsidies. So Nebraska's right there at a $2.28 producer loss ratio historically. That does include 2014, which had a pretty high loss ratio. But you can also see these last 4 years that we have data from complete. We're all over 2, and 2022 was up over $4 per dollar of premium put in by the producers. So it does pay out. It just is not, it's used a little bit in Nebraska, a big uptick in the last few years, but still relatively minor if you look at the national summary. So this is available in North Dakota, South Dakota, Nebraska, Kansas, Oklahoma, Texas, and then New Mexico and Colorado, 8 states. And it's been around since 2014. Colorado first year was in 2016. New Mexico's first year was 2017. The other 6 states have had it all the way back to 2014. Again, you see growth in it over time, up around 20,000 policies being sold in the last couple of years. Again, a lot of indemnities still to be, and premiums still to be determined here in 2024. So these totals don't total up, don't include 2024, but we can see some of the increase that we have here in these. Sorry about that. My daughter's dog is a little upset. But anyway, you see some of these increases that we have here in terms of policies earning premium and indemnified, and overall, most policies earn an indemnity. And about 7.2 million acres covered last year, $447 million in premiums total, and over half of that was subsidized. And we ended up last year, 2023, with about a 1.25 loss ratio overall and about a 2.61 producer loss ratio. And historically, we've seen about a 1.5 loss ratio overall and a 3.16 producer loss ratio. Now, you may be interested how Nebraska compares to those other states. This is the 5-year average, or 6 years, sorry, from 2018 through 2023. You can see in terms of policies sold, Nebraska well below the other states. Policies earning premium, close to right around North Dakota and South Dakota are about our only ones that are close to us there. We do get indemnified fairly regularly, just like everybody else. So as far as Nebraska goes, we're lagging quite a bit behind in terms of just overall use of the product compared to, in particular, Texas, which is dominant down here. About almost 2 million acres covered over this per year, 2 million acres covered over this 6-year span, compared to Nebraska, which has only been covering about 16,000 acres. So we don't use this near as much as some of the southern states do, in particular Texas, Oklahoma, New Mexico, and Colorado are some of the biggest users of this. But overall, Nebraska has paid out fairly significantly. 252 is our producer loss ratio over that 6-year span. 1.22 was the loss ratio overall without the producer subsidy included. So we had about a $43 per acre indemnity over that time, and producer premiums going into about $17.24 per acre. And you can see how that compares to some of these other states. And last slide is this one here on the coverage at different levels. And I thought you might be interested in seeing this. This is for the 2023 crop year. So this would be starting in mid 2024 running through 2023 production year with annual forages. Just for Nebraska, most of the coverage, as I mentioned early on, is at the 90% level. And this is just the ones that premiums were actually paid. We did have quite a few at the 85% level, just a handful down here below that. Most of the policies are indemnified. It doesn't really matter when you or what level you insure at. Odds are pretty good with you there that you're going to get some indemnity over time. About 40,000 acres of this was at this higher level, much less at the lower level. And then you see how this is just the net for the producer's perspective. So this would be the, keeping in mind the indemnities in place there. So this would be the producer premium being subtracted off from the indemnities that are paid out. So with the exception of this one policy here at the 75% level that didn't pay out, we could see all of them ended up positive. All of them ended up with pretty similar strong producer loss ratios. This is just for the 2023 crop year. I think our producer loss ratio here was like 2.11 or 2.14, something like that. Overall, of course, dominated mostly by this 90% coverage level. So they are charging you a fair premium. That fair premium goes across the board. You're getting that 51 to 59% subsidy level. So if enough people insure at these different levels, we pretty much see very similar producer loss ratios over time, depending on, so the coverage level itself doesn't make a big difference is what I'm getting at in terms of the producer loss ratio. Okay. So just to summarize, our annual forage insurance, need to get signed up for it by July 15th. It's available in all counties in Nebraska, as well as our neighbors to the north and south. It does use that 2-month rainfall index, and you can cover up to 90% normal precipitation, just like you can in PRF. It's for coverage on annual crops. The intended use needs to be for livestock feed or fodder, but there's a lot of leeway in terms of how you actually make use of it, including grazing and mechanically harvesting it in some fashion. So all of that's there. The tricky part is all that sign up needs to be done by July 15th. For any that you plan on planting between August 1st of 2024 through July 31st of 2025, and you need to get that coverage in place with your insurance agent between now and July 15th, and then report your acres when you plant them. So with that, I am going to go ahead and stop, and we'll see what we have for questions. Do we have any questions come in, Anastasia?
We have not had any questions yet.
Okay.
If you have any questions, feel free to put them in the chat. We'll give a little bit of extra time here for people to type. Jay, do you see that?
Yeah.
Okay.
85 to 90% because of the subsidy. Yep. Yeah, the subsidy goes from 51% up to 55% if you drop down from 90 down to 85. Similar if you drop from 80 down to 75, the subsidy goes up from 55% to 59%. So there is a benefit in terms of that initial premium that you have to pay. You also get a benefit because you're covering less of the rainfall. So there's two pieces to that. One of them is that obviously the subsidy goes up. But probably even a bigger piece is the premium rate goes down just because you're only covering 85% of the rainfall instead of 90%. Odds are less that it will drop below 85, then it will drop below 90. So odds go down. Plus, you're giving up another 5% of that rainfall as more or less a deductible. So it does go down quite a bit. You save on the premium. it's going to pay off less because there's going to be some of those times where you have 86% of normal, so you wouldn't get an indemnity if you had the lower coverage level. You would if you got the higher coverage level. And of course, if you had 82% of normal, you'd only get a 3% indemnity coming back to you if you had 85% coverage versus an 8% indemnity coming back to you if you had 90%. So there's a lot of moving pieces there. As we can imagine, it would be cheaper to insure. There'd be a few times that you don't get an indemnity with the lower coverage level that you might with a higher coverage level, and then the indemnity coming back to you would be lower. So all of that sounds negative to dropping lower, but the main thing is it's all actuarially sound. So what I've done with the numbers is if there's enough people doing the policies, say at the 70% level, and enough people doing the policies at the 90% level, the actual payback in terms of per dollar of producer premium paid is very similar across the board. It's just a matter of how you want to look at it. And for some people, they really they don't like the idea that they left money on the table when it's, say, 85% of normal and they had 75% coverage. Other people realize how those numbers work and they like to save the money on the premiums. So good question. We do see a lot of the lower coverage levels on the PRF in particular are with the large ranches in the sandhills. They'll quite often insure a large number of acres over a large area at a lower coverage level, so the dollar outlay is lower, and then they only get the indemnities when things are really dry. But keep in mind, it only has to be really dry for a couple of months for that indemnity to kick in.
Once again, that question was, is there any benefit to looking at 85% level versus 90% level because of the subsidy? Any other questions? If not, we'd like to thank everyone for joining us today. A recording of the webinar will be posted at cap.unl.edu, where you can also register for our upcoming webinars. Again, we like to host those on Thursdays at noon. We really appreciate your feedback on the brief evaluation that pops up when you exit Zoom. If you would like to see any topics discussed in the future, please enter that information there. This helps us decide what to discuss in the future. Thank you, Jay, and thanks again for joining us, everyone.